Guest waiting by
Sure.
Sanjay Agarwal, Senior Director at Head BFSI at CareEdge Ratings. Sanjay, lovely to have you on the show. First of all, your initial thoughts on what the RBI has done and the future rate trajectory before I get into the specifics.
Yes, so this is a very good move to reduce the policy rates by 50 basis points and the added bonus on the CRR cut. Liquidity in the injection of 100 basis points is a good move. So overall, a good policy for the sector. I think it's a great thing.
Right, Sanjay, going CRR cut that
Hello.
mobilizes 2.5 lakh crore and increases lending as well, right? But it would lead to significant margin pressure for banks, at least in the near term. So how do you think banks will navigate that?
The advances have seen some bit of a decline in the growth. The deposit rates have not been coming down; they have been sticky, and that is what the banks are fighting out. The concern with the advances is that the larger borrowers, they now have a very strong access to the bond market, and bond market prices have tumbled very strongly in the last 2 to 3 weeks, especially the differences between the AAA rates and the GSEC rate that has tumbled a bit. So this will give a edge to the banks to be able to, let's say, reduce the loss of business that they probably would have had.
Okay, that's the view. But how do you really look at the banking space now? Because would you look at the banking space at least into the near term through NBFCs because their cost of borrowing goes down? So would it be more positive for NBFCs in the near term?
So the larger NBFCs had the benefit of the reduction in the spread, which I told you just now. I mean, in let's say 4 weeks, about 50 to 75 basis point reduction had happened, and the best of the NBFCs are now borrowing at somewhere around 7.5%. Yeah. So that is where the whole spreads are 6.5%. Sorry, and that is where the spreads are, and that has been pretty challenging for the banking sector to get the rates to that level. This will help them ease the liquidity and hence reduce the interest rates and the pressure on deposit that they were having since the CD ratio, as the governor had said, is at 81%, so that's pretty high. So this will help them in garnering the resources or whatever the diversion of resources were there. They'll be able to use it for the business, and it will help them reduce the rates for the borrowers. And as far as the larger NBFCs are concerned, they have a strong access to the bond market. The rates have been very benign, so they would continue to flock to the bond markets. And to a certain extent, even the securitization, etc., markets would probably a bit of that would move to the bond market since the overall gearing in the system, both the banking and the NBFC system, is very low, and the capital adequacies are very high. So there's no issues of capital at the system at any level, and hence this brings quite a bit of equilibrium in the system.
Another question really on how to really, what are the how to really play this rate cut cycle in terms of the banking universe. Would you, tilt more towards PSU banks? And within the PSU banking pack, would you look at the large ones or the mid-cap ones?
If you look at the lending, the private sector banks are about 80-85% in the EBLR. A lot of it is repo linked, whereas in the public sector banks, about 30-35% is the EBLR. Again, a lot of it is repo linked. So today, the large part of the PSU banking system is more MCLR based, whereas the private sector bank is more EBLR based. So the transmission in the private sector banks will be immediate, whereas the public sector banks would have to go through their own motion. Then probably many of the borrowers would now want, especially the corporate ones, would now want to switch over to the EBLR system. So this transmission will take its own time in the PSU banking system. The larger problem for them would be in terms of the large borrowers moving towards the bond market. That I think would be a larger hit, and they would have to reduce the rates throughout the system to save that.
Sure. Last question really. I also want to get in the valuation picture. For PSU banks, valuations at one point in time were zero point 0.5 price to book, but now they've increased to 0.8, 0.75, in that range. Do you expect the gap between private and PSU banks to get narrowed further? What's the picture looking like right now?
So first we discuss the PSU banking space. The PSU banking space has seen very good days of late.
Hmm.
The largest issue in the PSU banking space was the
Yeah.
credit cost. And now the credit costs are absolutely low, something around 50 basis points. Even the net NP is very low at 50 basis points. So the picture out there is very good. Having said that, now we probably have seen the end of the credit cycle, and that's what we've been saying for last almost 12 months now. So neither the NPA figures nor the credit
Hmm.
cost figures would go down from here. That is issue number one. The issue number two is we see a constant sort of a reduction in the net margins, NIMs as we call them. So NIMs have been declining over the period, and the system level NIMs are something around 3% right now. We expect some bit of further decline for,
Hmm.
let's say, 6 to 12 months when the lending rates will go down immediately, but the deposit rate will take its time to reprice. So the NIMs will also get impacted. The credit
Sure.
cost decline, which was there,
Hmm.
remains where it is. The OpEx also seems slightly steady. So we see that the overall return on assets would continue to have some bit of negative pressure. The profitability growth will have to come from the increase in the
Hmm.
balance sheet size. And as I said, the capital is not an issue.
Hmm.
Everybody is very, very capitalized. So the banks would be able to grow the balance sheet provided they are able to fight it out in the market. So this is a new sort of a phase we are seeing in the
Sure.
banking sector where the fight is on the market space and not on the rates as such. The rates would tend to be negative. Having said that, the latest pattern that we see
Hmm.
in the last 3 to 6 months is that the banks have sharply declined, reduced the deposit rates. Now that is the posturing that the banks have
Hmm.
done, given the fact that the deposits are short. So whether the banks will be able to succeed, because some banks may actually start losing the market share, and then the internal management would have its own issues. Like right now, banks have largely moved away from the bulk deposits, right? Now, so similarly, and the
Hmm.
banking sector was also asked to move away from the high yield lending assets, let's say the unsecured personal loan and some bit of NBFCs, etc. Now the low yield assets will move out because they'll move to the to the bond market. So it's a bit of a situation which we'll have to see. But two things are very clear right now. For some time, we'll have NIM pressures, and the other, that would reflect into the pressure on the ROA. That's as far as the PSU banking space is concerned.
Hmm.
And the private sector banking space,
Sure.
again, they had the
Sure.
challenges on the deposits. So the deposit challenge
Hmm.
now seems to be
Go
reducing
on,
because
Sanjay.
the larger private sector banks, they have been able to make good bit of the business loss. So while we see that the larger private sector banks, the private sector banking asset growth was about 9%. But if you include the assets which they have sold off during the year by securitization, PTC, etc., the asset growth actually
Hmm.
is higher at 10, some slightly higher than 10. So the business is good out there. They've been able to stabilize
Hmm.
the deposit rates. So there the competitive strength seems to be slightly higher. Having said that, the NIM pressure
Hmm.
would remain for some time, and probably it will take us 6 to 12 months to find out whether the banks are able to fight back on that.
Sure. Sanjay, I had more questions for you, but due to paucity of time, I can't pose them to you. But I will get you on one of our morning shows soon, and I'll get those questions addressed. Would like to thank you for taking
Thank,
out time and joining in. Nevertheless,
thank you. It's a pleasure for me, and thank you
well,
very much.
thank you. I want to point. Thank you.